Let me begin by introducing the Honorable Richard Breeden, who is, as you know, the chairman of the SEC. Prior to being appointed in October of 1989 as chairman of the SEC, he was the assistant to President Bush for issues analysis. Actually, Mullins and I were his first issue. He was essentially put in charge of keeping Mullins and me out of trouble, as all three of us worked on the S&L bailout legislation in 1989. Before joining the Bush White House, Richard served as then Vice President Bush's staff director for his task force on the regulation of financial services back in the mid-'80s. Thank you very much for coming. The floor is yours.
Thank you. Do you want to do it there or come up here? I think it's probably easier to come up here.
You can see your tie.
Well, thank you very much. I would like to start out by incorporating by reference everything that David Reuter, Rick Ketchum, and Nick Brady had to say, which is the last time I will address the jurisdictional question, having had a full lifetime quota of the pain and suffering that comes from discussing that issue. But, Bill, I'm glad to hear that the Merc is now in favor of it. Though I'm holding my wallet, you must want something. Just as an aside, before discussing the assigned question of future risks for the markets, I'd like to throw in my own 2 cents about one of the most significant changes since '87, and it is true that an enormous amount of progress made in addressing the specific recommendations enunciated by the Brady Task Force and to create circuit breakers and cross-margining and the like. But in my book, the single most important change since then has been the enormous resurgence of the equity markets and the role that they are playing in the formation of primary capital in the United States. When I became chairman of the SEC in 1989, total public offerings were $308 billion. In 1990, the total was about $318 billion. 1991, $600 billion. And 1992 will finish with just around $900 billion in public offerings. At the same time, we have had hopefully a temporary problem of net liquidations of bank, commercial, and industrial loans. The banking sector has, in the aggregate, retreated from lending to the broader economy, and it has been the securities markets that have stepped in an enormous fashion to fill the needs of capital of the American economy. And that has increased the traditional importance of the equity markets as providing the wherewithal for the economy and for large and small businesses alike. And that, to me, is an enormously important change. It's a change for the better, and I think the increased confidence that has in part been engendered by some of the positive reforms the Secretary mentioned has something to do with the fact that investors have returned to the market in a big way, and we're seeing such high levels of capital formation. We've also eliminated the long period from 1983 to 1990 in which we had over $500 billion of net equity destruction, the volume of LBOs and buyouts replacing equity with debt to the tune of just over $550 billion. In the last 2 years, we've had $50 billion net equity formed in 1991, and we're looking to hit around $75 billion net new equity for 92. So we've gone back to the business of restoring the equity base for the economy, and that too, I think, is a very healthy sign for the future. Well, in terms of our topic that we are assigned to address, the greatest risk to market stability, let me toss out a couple of thoughts. First and foremost, I would suggest that whatever the cause of the next big problem, it will be something that will not be discussed here today. And the fact that we're not worried about it is exactly why it will be the problem that gets us next time. And so if you would like, feel free to disregard everything else I have to say, because it will undoubtedly not address whatever our future problems might be. I think that we have made some progress in dealing with uncontrolled leverage. Unfortunately, while some people think the SEC's view on this subject comes from the fact that we don't understand the differences between performance bonds in futures markets and margins in securities markets, the opposite is true. The reason we spend so much time worrying about it is we do understand the differences and the similarities. The 2% margins that we saw in the past, in history, are hopefully gone forever. That level of leverage is, in my judgment, not safe and leads to the problem that when you were in a crisis, and this was one I saw firsthand, not in '87 but in '89, that when you go into a period of extreme market stress with your margins down around 2%, you will be forced to raise margins precipitously in the midst of the crisis, thereby draining liquidity out of the market at the time when it is most vulnerable. Had you been fortunate enough to go into such a crisis with margins at 10 or 15%, you would have room to cut margin levels in the midst of that stress, or at least maintain them level, thereby not worsening a liquidity problem. Happily, Congress has begun to address this question, and I'm certainly encouraged that the recommendations of the SEC and the Treasury to confer margin authority on the Federal Reserve ultimately were adopted in the Congress. I am equally hopeful that the Fed will do a careful and thorough study, and at the end of it will have the good sense and courage to set some benchmarks below which margin levels ought not to fall, and I would leave totally to David and his colleagues determining what those levels are. But clearly we've seen it in many areas of financial markets. Leverage up to a point is just fine, but uncontrolled leverage can really be a problem, and it's something to worry about for the future. Second would be, of course, the risk of some type of liquidity failure on a broad-scale basis. That could come in the event you had a serious problem with the clearinghouse. It could come through the clearance and settlement system. The Secretary has addressed the importance of clearance and settlement. I would underline and reiterate everything he said. It is truly a very, very critical system. In fact, when we went through the exercise of having to liquidate Drexel Burnham, it was the clearance and settlement system to pick a different type of event other than a market crisis. But there, too, in Drexel Burnham, it was clearance and settlement where we had the greatest problems. And there were a number of parts of Drexel's portfolio that could be easily liquidated. There were other parts, including some of the mortgage-backed certificates, that were in paper form, no electronic settlement, and in which everybody sat around waiting for the other guy to go first. If you pay me in full, I'll release my collateral. Someone else saying, once I get the collateral with no liens against it, free and clear, and my lawyers have sworn that I've got it, then I'll pay you. And everybody sits and looks and says, well, who will be brave? And of course, in a crisis situation, nobody wants to be the guy who let loose of the collateral and saw something happen that you didn't get good payment for it, and then everybody in your company saying, now, why did you do that? So clearance and settlement is truly important, that we make sure that not just for equities, but for all types of instruments where we have significant positions in the marketplace, that we are satisfied that the clearance and settlement system can handle times of stress, whether it is high volume, whether it is high volatility, or whether it is the failure of a large institution, and the clearance system has to be able to absorb all those things. We have been working very hard with the securities industry to continue goading them to move to T+3 settlement, hardly as good as already exists in the futures industry, and I take my hat off to our colleagues in the futures industry for a clearance system that works much better than that in the security side. T+3, you would think, would be leisurely enough in an electronic world measured in nanoseconds that we could get there after a period of a number of years of effort, and yet that still is proving a goal that some in the securities industry resist the effort to achieve. We similarly would like to see same-day settlement in same-day funds, not next-day funds, and believe that both of these reforms are really critical steps. The next step, I believe, for the SEC will be to set some deadlines for the securities industry. They need to be a few years out so that we don't cause unnecessary costs to be incurred. We want to give the industry plenty of time to work out the mechanics of these steps, but frankly, the industry has already had plenty of time, and plenty of time cannot be synonymous with forever. And if it takes a little nudge from the government, then perhaps that is exactly what we need, because I do think that we need to continue the progress that has occurred to date and bring those reforms onto line. Probably the most serious problem we face is complacency. There is a great habit in government and perhaps also in the markets to fight the last war. We have, of course, richly documented, with or without the elusive tapes, richly documented studies of what went wrong in '87. In fact, these days, the minute there is a slight up or down in the market, you can look at your watch, count to 30, and a letter will arrive from a congressional committee chairman asking for a reconstruction of just what occurred. Now, the market can bounce back the next day and be 200 points higher than it was at the close of the day before. It doesn't matter. Go ahead and do the report. But nonetheless, we tend to do these very thorough and careful studies of situations that occurred in the past. We spend a great deal of intellectual effort trying to make sure that problem can't reoccur. And it is important to do that, but it is also important that we not come to believe that having figured out the last problem, that means that we won't have the next problem. Overconfidence and disregard of economic fundamentals in country after country come home to roost in a most unpleasant manner. Just about the time that people start saying, well, everybody ought to get into real estate or collectibles or stock or rugs, it doesn't matter what it is, buckle your seatbelts and get ready for trouble. Because when people lose sight of the underlying economic fundamentals, you are creating a vulnerability to a sudden restoration of sobriety that sooner or later will be occasioned by some external event. That might be characterized as the theorem that for every balloon there is a pin, but when you inflate a bubble in any market, sooner or later the bubble will be deflated. It may happen suddenly, as the repricing in '87 and again in '89 happened, or it may happen gradually, as has been the case in Japan, where a massive quantity of value has been shaved off the capitalization of the Japanese exchange over a 2.5-year period of steady decline rather than a sharp break. We should all be very glad that it has taken the Japanese as long as it has to see that value deflate, because if it had happened quickly, we would still be picking up the pieces. Clearly, the external shocks that the Secretary mentioned are one of the great imponderables. It is important to try and have a system that can absorb those shocks wherever they may come from, and speculating on where they could come from probably is not too helpful. Looking at history, you can identify a few possible causes of such a problem, an external shock. One could be the failure of a major firm without warning, without expectation. If you look at the situation that was faced in Salomon Brothers, where you had a firm that had been thought to be the most heavily capitalized, one of the strongest firms with a huge book of exposure around the world, if that expectation that Salomon is a superb credit is in a relatively brief period of time reversed by events that may occur, whether they're law enforcement events or other types of events, then you have the vulnerability of a shock emanating out of the problems in a single firm. Had equity funding occurred in a major broker-dealer with positions both on and off balance sheets of the size that some firms have today, the markets could have a real problem. Happily, I believe the thoroughness and quality of our oversight of capital requirements of broker-dealers makes that fairly unlikely. But nonetheless, a failure of a major commercial bank or broker-dealer certainly is one possible risk. A systemic problem among securities firms or banks is certainly another possible sufficient shock to public confidence that could trigger serious problems. When I look at the hundreds and hundreds and hundreds of billions of dollars of U.S. government securities, fixed rate, held by U.S. banks with a zero, under the good old Basel standards, zero capital risk weighting, if you project a sudden spike, and I know David would never let this happen, but if rates were to spike 200 or 300 basis points for whatever external reason, there would be a lot of banks who, notwithstanding their own cost accounting for their value of their portfolio, would suddenly have a very significant change in aggregate net worth across the board in the whole system. And I'm not suggesting that that is in the cards either, but whether it is an individual firm or systemically, safety and soundness problems certainly could be the cause of a sufficient shock to the market to cause problems, and that's why continued strength of supervision, while it is important not to over-regulate, continued strength in the basic supervision, capital levels, examination, the blocking and tackling of supervision remains terribly important, both for broker-dealers and for commercial banks. Foreign currency risk, I will leave for others to talk about, beyond noting that had the events of September that took place over a few days lasted a little longer, who is to say what the problems might have been? I don't know how long Sweden could have sustained 500% interest rates. It would have been a very interesting case study. It would have also been a marvelous demonstration of how well cost accounting works, I suppose. Clearly, we have seen brief, sudden shifts in currency values. If you got an equally sudden shift, but it wasn't so brief, there could be a lot of problems around the world, not unique to banks, broker-dealers as well. So currency risk is an area where we perhaps spend less attention than some traditional types of instruments, but where it seems the volumes in circulation create certainly a substantial aggregate risk. Finally, there is the risk that government might do, once in a while, something extraordinarily stupid. It's happened in the past, probably could happen in the future. We had a situation, since I'm here at the Kennedy School back in the early 60s, in which the late President Kennedy took some positions that the market didn't take much comfort in. The market bled off 20 or 25% following those positions, eventually recovered and happily didn't lead to a broader macroeconomic problem. While Nick believes that that as he described the external problems of a change in Gramm-Rudman and the role that may have played in '87, some would certainly want to add to the list the consideration by the Ways and Means Committee of significant changes to the tax rules that would cause a revaluation of implicit premiums on takeover candidate stocks. Whether or not that did or didn't play a significant role in '87, it is clear to me that public confidence can be given a heck of a shock by government if it isn't careful in how it conducts its business as well. All of that sums up to me to describe a system in which it is important to do everything we can to deal with the known risks. It is equally important that we recognize that there will be risks in the future that we have not anticipated, and we better leave some reserve capacity in the system to be able to absorb those problems when they come along. Thank you.
Thank you, Mr. Chairman. Our next speaker is Bill Brodsky. Bill is President and CEO of the Chicago Mercantile Exchange, where trades the largest future, stock index future. Bill has a rather unique background. Before coming to the Merck, he was an official of the American Stock Exchange, so he has seen it from both sides. Bill, please.
Thank you, Bob. Yes, in fact, I spent about 15 years of my career in the securities industry before crossing the Hudson to go to Chicago, and have now celebrated 10 years on the other side of the Hudson. So I have seen a lot of these things from both angles, and in fact, while I'll speak about Secretary Brady's comments a little later, I would say to you that I understand where he's coming from, but I don't particularly agree with his conclusion, and I'll explain that in a few minutes. Tom Donovan this morning talked about his 100 or so trips to Washington during a certain period of time. I was with him on most of those trips, and I'm glad I went. There were a lot of things that happened during that period, but we have some very strong feelings about the whole issue of jurisdiction, and although that wasn't necessarily what I was going to talk about, it just gives me a golden opportunity to explain our points a little bit. Let me backtrack a little bit, if I might, because there were some things said this morning about work that was done in the period since 1987, and I just wanted to add my own little insights into that. The first is on circuit breakers, and Bob, I want to congratulate you again on not only what you've done here today, but the prodding that Bob Glauber did, not only in his role as Undersecretary of the Treasury, but when they put together the Presidential Working Group, which I don't think has been talked about at all today. But really that, to me, was one of the most important things. The Brady Report itself was an important piece, but it was really a piece that sat on the table. And the question really was, what do you do to implement some of these things? And a lot of it related to the spirit of what was talked about in the Brady Report and how we came together. I agree with Dick Grasso in terms of the cooperation that we have today, but that took a little time after 1987 of bringing us all together. There's no question that we are in a totally different environment today than we were then. One of the things we learned, sort of a theory of adhesion, and that was that if we didn't work together, the government might do something to us, and that helped bring us together in a very, very positive way, because if you do look at the Brady Report and you look at the things that were recommended, to a large part, most of these things were accomplished, and it was accomplished because the private sector felt that they really knew more and could do better together than having it imposed upon them by some patchwork of government regulation and congressional legislation. So what I did for today is I took a look, for example, at circuit breakers and said, how many times have we triggered these shock absorbers and circuit breakers? And the comment made earlier was true, that we really haven't hit the real circuit breakers that were viewed in the Brady Report of the big drops, the what I'll call the 250 Dow and the 400 Dow. Happily, we haven't gotten to those. But there were 24 occasions when the earlier limits were hit. And of the 24, I did a little statistical analysis of my own. 7 were occasioned by the Gulf War. 3 were by physical emergencies in New York, problems at SIAC or power failures, etc. And 2 by the Soviet coup. So a total of 50% were accounted for really by external factors that had nothing to do with market ups or downs. Of course, the biggest during that period was the UAL buyout. And in fact, of the 24 total, 6 were when we hit the S&P 12-point level, which is the 100-point trigger. So half were related to that. But I think what's important, and what was discussed earlier, is that to many people, circuit breakers were looked at as an anathema. Leo referred to it earlier. I was very much part of that decision. I can remember coming to Chicago from New York in 1982 and talking to people in the investment business. They said, you guys are crazy. Why in the world do you want circuit breakers? We want these markets not to disconnect. Well, of course, what happened was history. But what's really happened on the circuit breakers, in which we didn't know at the time of the Presidential Working Group, was with these circuit breakers, or these shock absorbers that we have, what we have at the Merck is the early morning level of 40, the equivalent of 40 Dow points at 5 S&P points, and then the 12-point level, which is approximately 100 Dow points. And that is, would these become a magnet? Will these draw the market down in a deleterious way? And the answer is that, although there were fears about that at first, The reality has been, and the practice has been, that the people have gotten comfortable. They understand the certainty of circuit breakers that we have, and they understand that the markets will go up and down, and there are going to be times when we're going to hit these limits. But what they know is that there is certainty that when the limit is hit, whether it's a half hour or however the particular provision works, they are comfortable because of the certainty. There's not a guesswork. Will someone come in and blow a whistle and stop the market, as we had to do at the Merck on October 20th of that year? So what I see right now is that we've now had 24 experiences in about 3.5 years, and no one's complaining. And you could look at from afar at what we've done and the activities at the New York Stock Exchange and Rule 80A and some of the other sidecar things, and say, how did you end up with all these things? Well, we ended up with them because each market has its own culture and its own politics, if you will. But I think what's resulted has been a very positive overall result. I want to share the concern about the issue of clearing and the need to make sure that we've done everything we can in that area. I would point out that certainly from our perspective, we've done a tremendous amount in the last couple of years on clearing operations. I'll give you a few examples there. We no longer accept letters of credit for security deposits. Our performance bond collateral now allows, for the first time, and it was written up in the newspapers just a few weeks ago, a global settlement fund. We now have 24-hour access to funds through a mutual fund produced by one of the major banks in New York. This is a major advance in terms of collateral on a 24-hour world. We have at the Merck alone a $250 million line of credit, so that in the case of some gridlock on a particular day, we can draw down on that $250 million at a moment's notice. Cross-marginings that Duke mentioned, that to me is one of the great victories since the 1987 period. My only frustration is it took so darn long to get it through our two government agencies, the SEC and the CFTC. I'll refer a little bit to those things later, but we are on the way to extending that to the full panoply of market users, not only the proprietary accounts which are actively using it, market maker accounts which have just started to use it, but there are institutional accounts that are interested in that as well. We created a system since that 1987 period called SPAN, which is the Standard Portfolio Analysis of Risk, and we use that not only at our exchange, but we've made it a global standard. 14 exchanges on 3 continents use the system that the Merck developed to analyze risk in a portfolio, and again, that has gone a long way to protecting the systemic concerns of the clearance and settlement system. We initiated at the Merck a clearing bank roundtable. That roundtable has met 14 times between 1988 and 1992 and continues to meet, and again is an indication of how the futures industry, the securities industry, the clearing organizations, and the banks are interwoven. The Fed has put out for comment an extension in its hours for the Fed wire system. That comment period is current right now. I encourage anyone who's interested in that subject to support that. We think that keeping the Fed wire open longer is an important aspect of what we learned in 1987, and that is the money has to flow, and in times of stress, you need more time to process the information. We no longer have a margin problem. You can look at it from one point of view, that it's now in legislation, and the Fed has oversight. That may be one reason. The other is we don't call it margin anymore. We call it performance bonds. In fact, I met a good professor here, I don't know if he's here right now, who said to me, why don't you just change the name of margins to performance bonds? Well, in our rules we did. It doesn't change the views of some people, and I find that unfortunate. I would comment, whether you go back to the 1987 period or the 1989 period, that never has anyone established that leverage was a problem as it relates to performance bonds or margins in stock index futures. In fact, in 1987, the only firms that failed in the investment business were on the security side, not on the future side. And that's not to say that we take the issue lightly, but I think you have to recognize that in our industry, the issue really is variation margin, or the money that flows based on the daily mark-to-market of the positions. The issue of initial margin or maintenance margin is an important one, but is really separate from the flow of funds. And those funds flow now on a daily basis to a point where on days of high volatility, before our markets close, 85% of the money change of that day is already in our hands on the day of the trade, not the next day. Now let me get to the question that the good professor asked me to address, and that is, what are the greatest threats to orderly markets? A lot of these points were covered. I agree with Chairman Breeden on several of his points. I would say that as a general principle, what we have learned is that the markets work and that the markets are going to ultimately determine the price of and the value of instruments that we trade. What I find fascinating is that the interest in growth in stock index products has grown to a point where we now have at least 90 products trading on 38 exchanges in 19 countries of the world. If that isn't a testament to U.S. innovation and financial services innovation, I don't know what is. The role of derivative products and the influence of indexation. The word indexation didn't come up this morning. I found it interesting. Everyone talked about portfolio theory, but I want to get indexation out on the table. Indexation is probably one of the most important forces in our country today in terms of portfolio management. I don't expect indexation to take the place of good stock selection and fundamental analysis, but I think that the case for indexation is most compelling. And we look at what we're doing as a way of helping to foster the way that people, and particularly institutions, invest their money. If you look at the period of going back about 5 years, when 85% of the stock mutual funds in the United States couldn't outperform the S&P 500, I think the case for indexation, at least during that period, is obvious. Beyond that, I think the greatest threat that we face is the issue of overregulation. I am totally in favor of regulated markets. In fact, we've done everything we can to coordinate and work together. But what I found is that when there is an issue of market safety, people will sometimes tend to overregulate. The chairman of the SEC just said that he was glad that Congress didn't do certain things. I'm glad of that too. I think that working together between the regulators and the private sector industry is the best way to do it, because with all due respect, I don't think Congress has the expertise to know how to regulate these enormous markets. But what I think is most important is that there should be more of a cost-benefit analysis done before regulation takes place. It's very easy, as you saw in Japan in the past year, as their market slid and slid and slid, for their regulators to do all sorts of knee-jerk things, almost in a panic mode, to try to protect some amorphous concern that they have about their markets. Obviously, they had a concern about it, but I think they overreacted and hurt their markets in a very dramatic way. In like manner, I am concerned that for our markets, that if we allow overzealous regulation to take place, we will lose the brilliance and genius that exists in our markets, and particularly in areas such as products that can be moved overseas very, very quickly. You mentioned, Chairman Breeden, about being at the Kennedy School, and I can reflect back to my first days on Wall Street when I learned about the interest equalization tax and how destructive that was to the Euro bond market, and a market that never came back to the U.S., because what happened is we taxed it in such a way that that business stayed in London and never came back. And those are the kinds of things that concern me, and they take many, many different forms. Secretary Brady talked about how the world has changed. Well, how right he is. In fact, to a large extent, the Brady report in many respects is obsolete. Our markets have moved so quickly in the 5 years that anyone who uses the Brady report as a basis of how our market should be regulated has to go do another study. There were a lot of comments earlier today about the off-exchange market. We have concerns about that as well. We're on the record about that. But one of the concerns that I have when you talk about regulation and whether the SEC should be regulating equity derivative markets is that I think it misses the point. And to say that we have supported the merger of the SEC and the CFTC totally misses the point. What we have said in recent weeks is, now that we've gotten this torturous 3.5-year reauthorization process behind us, shouldn't we be looking at our financial markets as a totality? What people don't understand, and I spoke to some today, I said, do you know that stock index products are approximately 10% of the Merck's volume? Well, the Merck certainly doesn't want to be under the SEC, where 10% of its business is in equity products and the other part's not. But then you have to look not only at our business, but other exchanges and other firms. Think of the Salomon Brothers government bond situation. Think of the foreign exchange crisis of September 1982. We're talking not only about a global market, but we're talking about our banks and our securities firms that are in all these businesses. What we're suggesting is that we have an opportunity now. We have a new administration, and we have a recognition that we are in a total global environment, and we are still the leading country in the world in financial services. Shouldn't there be an overarching view of all our financial services and not just pick on one and interestingly, probably the smallest sector, which is the equity markets? And so, for anyone who thinks that we're supporting a single regulator, which we have viewed as a hostile takeover by the SEC of the CFTC and hence our equity markets, is missing the point entirely. We view the financial services industry of the United States as one of the really strong parts of this country as it faces the world in a very high technology environment. And we believe that if we're going to do anything, there ought to be some overarching body that looks at interest rate swaps, equity futures, leverage buyouts, all of this in one way. And I don't have a specific form to give you right now because I think that should be done in a very thoughtful environment. But we certainly don't look at our equity futures as being the sole object of a single regulator. Another comment I'd like to add is that Secretary Brady mentioned briefly that he thinks that the world of the future may see the elimination of trading floors. I'm not so smart as to predict what the future will be in the long term, but I would say this to you, that no one in the world has invented a marketplace that has provided the liquidity that our stock exchanges have provided or our futures and options exchanges have provided that has been done other than on trading floors, and that's from an institution that currently is using electronic trading systems for after-hours trading. Our obligation in running marketplaces is to provide the maximum liquidity for the users of our markets. And what we're trying to do more than anything else is enhance the liquidity of these floors through proper automation, because I think that way we will continue to serve our users. How long the trading floor will be the main source of liquidity, I can't tell you, but I can tell you we're committed to making it the prime source as long as we can. And finally, I want to just congratulate Bob Glauber again and the Kennedy School for this excellent conference. It's good to see all these old friendly faces together, both from my securities world and my futures world. Thank you very much.
Our next speaker is Bill Donaldson, who is the chairman and CEO of the New York Stock Exchange. Those of us who have a Harvard Business School background know his name best as the co-founder of Donaldson, Lufkin, Jenrette, which for generations has hired Harvard Business School graduates, for which the school, I'm sure, is no doubt very grateful. What you may not remember is that Bill also had a government career. He was Undersecretary of State in the Nixon administration, and an academic career. He was the first dean of the Yale School of Management. Bill?
Thank you very much, Bob. I want to join the chorus of people thanking Bob for bringing this group together. However, I have a small complaint, Professor, which is that in making these assignments, you assigned our morning panel the job of telling us what had happened. You assigned the afternoon panel the job of what is going to happen.
Vision.
I used to get paid for predicting things, and I was always glad when people forgot what I had to say. It's a much tougher job to, I think, to predict. You know, I have sort of, the second part of the unfairness of this is that when you come late in the day, a lot has been said by a lot of people, and one has to tear up everything that you were going to say and try and add something. I have a little bit of a feeling that this may be a little bit like a gathering of the French generals after World War I, discussing the construction of the Maginot Line and deciding that although it maybe should go a little farther this way and a little farther this way, that the height was just about right, the thickness was just about right, and we certainly were not going to have the problem that we had before as a result of it. I think the second image that comes to my mind is a book that we were fascinated by years ago at Donaldson, Lufkin, and Jenrette called Popular Delusions and the madness of crowds. And I think that when one studies the tulip mania and all the other popular delusions and madness of crowds, I have this image of the crowds still now having their finger on buttons and pushing machines, but still being subject to madness and group behavior and gnats moving, as we heard this morning. What we've been asked to talk about is what factors are the greatest risk to orderly markets. And I'm going to say that I want to define orderly differently than what has been talked about up until now. Up until now, we've talked about volatility, we've talked about declining markets and ascending markets. I would like to talk about orderly markets as markets that continue to perform their central function. In terms of our equity markets, the central function, of course, is capital raising. A secondary function or equal function is a store of value, a store of investment value. To me, the proper functioning, when you get beyond just the volatility of markets, is do we have structures that are going to continue to have our markets perform the function for which they're designed. But before I get to that, let me just talk a little bit about the assigned topic and some of the things that have been mentioned before, because I want to underline just a couple of statements that have been made before. The number one risk, and before I even talk about risk, I understand the presses here. I understand that this is not a pure academic setting, so I want to say that when we talk about risk, we're not predicting something that's going to happen. We're talking about something that could have happened. We're talking about a weak link in the chain. To me, the weakest chain we have out there has been mentioned several times, and that is the custom-made instruments in the over-the-counter market for interest rate swaps, equity swaps, and the custom design of instruments. In my view, it was interesting to me that we've had a number of figures mentioned here this morning about what the size, the nominal size of that market is, and that's ranged in this room alone from a passel of experts from 5 billion to 30 billion. I think that tells us a little bit about how much we know about what's out there. I was not amused, but I was interested when I had lunch with a president of one of our, chief executive of one of our largest banks a number of months ago, and he told me the story of having read in that morning's paper about a failure, a bankruptcy, and was patting himself on the back that they didn't have any of the paper and hadn't done any of the lending to that company, and got into the bank that morning and found out that they had a $25 million piece of this swapped risk that was buried somewhere in the bowels of that bank. They hadn't made any loans to the company, they hadn't done any credit risk analysis on the company, but they were holding a weak link and a piece of the daisy chain. I would submit that out there are all sorts of counterparty risks, there are all sorts of risks that really nobody understands. And I would go on to say that I think that the lack of understanding escalates as you go toward the top of the organization. The further you get from the bowels of the organization where these products are being created and evaluated, where people who speak languages that most top managers don't understand are designing these products. I suspect that people sitting on top of some of the largest banks and some of the largest investment organizations really just can't understand where the weak links are. So to me, that's the number one risk. I think in terms of the settlement and comparison side of things, we've got a long way to go. We've come a long way. We've come to next day comparison. I think we're moving from T+5 to T+3. It's painful. It's particularly painful for certain classes of investors and firms who don't feel that they have a risk out there, i.e. the retail side of the investment business that doesn't really feel they have a massive credit risk versus the big institutions who do. So it's not going to be easy, Richard. You know that it's not going to come. We got to have it come faster. We've got to get to same-day comparison, next-day payment. I fear that it's not going to come as fast as we would all like to have it come. There are a whole series of external risks that I am reminded of that threaten all the high technology that we have. We just have to look back over a couple of months to the Chicago flood. We have to look back only 3 days to the weather in New York on Friday and the absolutely unexpected flooding of a line of buildings in New York that contain some of our largest member firms. I'm reminded of my first day on the job in the New York Stock Exchange when Dick Grasso gave me a call at 5 o'clock in the morning and told me that the bad news was that there had been a bad fire in one of our buildings. The good news was that it was a fire on a floor that didn't involve where all of our SIAC computers were. Then I got a call a little bit later saying that we had now had bad news, and that was that there was a City of New York environmental protection man who had gone into the building and collected a bottle full of PCBs and was just about to get into a cab to take them over to some laboratory in New Jersey. And he thought he would be back maybe in a few hours or maybe day after tomorrow. But in the meantime, they'd sealed the building. And we tried to talk to this man about the fact that the markets were about to open in 3 or 4 hours. And that, anyway, point being that we got some help from New York City and solved that problem, and the markets did open. But the vagaries of what can happen to our high-tech society, and particularly our marketplace, is out there and is a great big risk. I think that in terms of the sort of cascading kinds of things that we had in 1987, this self-fulfilling, cascading market declines, I think that we have addressed those in terms of the circuit breakers, the shock absorbers. Bill, the Rule 80A has been triggered 56 times since it went into being. This is where the market is up 50 points, down 50 points. The index arbitrage has to withdraw and can only come back in counter to the market. It's interesting to me that a market has only been up over 100 points and down over 100 points twice during this period, and then a third time a couple of months ago, but ended in negative territory, but not 100 points. So I think the circuit breakers, we all agree, are working, or the shock absorbers are working. Circuit breakers, thank goodness we haven't put into effect yet, but I think the fact that they're prearranged is a very healthy thing. Let me get on to what I think are the really big risks out there, and they have to do with the markets functioning for the purposes that they originally designed for. The first is the whole issue that we've been on the fringes of, and that is passive investing, indexing, and the resultant commoditization of our equity markets. I don't know the answer to this, but I worry about the ultimate impact on the cost of capital of the commoditization of individual securities. I worry about the increasing role of price takers versus price makers. Reductio ad absurdum, 100 shares of AT&T will trade on the New York Stock Exchange, and X billion dollars will be priced off of that 100 shares. What is the impact on the allocation of capital in this country of this commoditization? I know I'm talking like an old-time security analyst, but who would have predicted the IBM situation? Who would have predicted that this was going to happen? I suspect that a good analyst might have. The second main issue is one that the good chairman on my left and I have talked about for a long time, and that is the whole internationalization of investing. And all I want to say on this subject is that if you look at the world on a global basis, roughly a third of the world's GNP comes from Europe, roughly a third comes from the United States and South, roughly a third comes from Japan and the Pacific Basin. And yet the most advanced pension fund probably, if it has an excess of 10%, it's pushing the limit. Some have 15. I'm told that the average retail investor in this country has somewhat less, they're somewhat just over 2% of their assets in foreign securities. However, I suspect and I believe very deeply that over the next period of years, I don't know how long it will be, that our portfolios are going to look a lot more like a third, a third, a third. The statistics are wild. 10 largest banks are non-U.S., the 9 largest electronics companies, the 3 chemical companies in Germany are larger than, each one of them is larger than DuPont, so forth and so on. We are going to escalate in a dramatic way. We, being the American investing public, we're going to escalate in a major way our investment in foreign securities, and by the same token, foreign investors are going to increase their investments in this country. There have been traditional foreign investors in U.S. securities in Scotland and England and Switzerland, to a certain degree in Germany, but there are very few U.S. equities in Japan, for good reasons. But all of this, I believe, is going to change, and as it changes, it highlights the global nature of the entire investment business. It highlights the fact that all of the players in the field these days are crossing international lines with offices, with representatives, and so forth. And we are going to be playing in a total global game that is going to increase, not decrease. Somebody said that globalization is here. It's just beginning to be here as far as I'm concerned. And that brings up the issue of global regulation. And despite the Herculean efforts of the chairman in terms of IOSCO, the International Association of Securities Commissioners, and his work to try and harmonize global standards, to try and standardize global standards, I think you would agree with me that it ain't easy, it ain't going to come fast, and we've got a terrific risk out there in terms of the direction that we're going in on the international front. The next point I'd like to make, and I don't mean this to be combative in any way, is that I think the issue in terms of our markets is not as Nick Brady said it was electronic versus a physically convened market. I think the real issue is auction markets and dealer markets, the different ways of doing business. And although we have, for a long time, had a very good, in my view, compatible relationship between the auction and dealer markets in this country, well regulated, and certainly serving the American capital raising system, I believe that we're seeing overseas the convening of dealer markets in most countries, in many countries, which are based essentially on a totally different principle than our market is. I mean, we believe in this country in total disclosure, transparency, as they say, immediate reporting, et cetera, whereas the markets overseas are 180 degrees around on the other side. Why? Because they have to be designed to serve the dealer. They have to be designed basically, or they have been and are increasingly opaque, delayed reporting, anything to basically obfuscate what's really going on in the wholesale end of that market, in order that the intermediary dealer can then lay off blocks of stock on people who have less information, who don't really know what the true price is of a stock. Now, what I'm suggesting is that in this global environment, I am very worried about us being caught in what I would call a regulatory arbitrage situation, where markets and transactions flow to the less regulated markets, flow away from what is a tremendous national asset we have here, both in NASDAQ and the New York Stock Exchange and the other stock exchange and the commodities markets, and flow to areas around the world who will compete on the basis of opaqueness and will compete on a basis of less regulation. I think that has serious long-term implication for our markets functioning in an orderly way. The last point I would like to make, and it really is related to the point I just made, and that is that I think we sometimes forget what a unique marketplace we have in this country. I mean, we have, and there is a market like this nowhere else in the world, we have 51 million individual investors out there. We've got 10,000 institutions. We have the common stock in this country owned about 50-50, and although institutions are increasing their ownership, we have a market that, because institutions and individuals can deal in the same marketplace in an environment of openness and transparency, have developed a confidence in that marketplace that has created a liquidity to it. This is very different than, let's say, in London, where there are practically no individual investors, with the exception of the distributions from the former state-owned companies. But I forget the exact number. 400,000 people with over 200,000 pounds is a number that sticks in my mind. They have a different situation over there. They've got a lumpy institutional market, much fewer big institutions. They have much fewer individual investors. That kind of a market needs an intermediary. The market that we have, where individuals can meet with institutions, not only provides its own liquidity, but it provides what I think is essential to our market, and that is 51 million individual decision makers out there. And I think that we forget how good our marketplace is, and I suspect that our marketplace is basically functioning really quite well for this country and the complexion of investors that we have. And I think the big risk now is that somehow we lose that as we move to this less regulated area. Thanks very much, Bob.
Thank you. Our next speaker is Joe Hardiman, who is the president, CEO of both NASDAQ and the NASD. NASDAQ, of course, as you know, is a dealer market. Joe arrived on the scene, according to my notes, in September of 1987. You had a time to check your coat and hat and get ready for October. Prior to that, of course, he was managing director of Alex. Brown in Baltimore. Joe?
Thanks, Bob. Dave Reuter this morning was talking about the most chilling telephone call that he got during the week of October the 19th of 1987. That was from John Phelan, who was suggesting that the New York Stock Exchange was seriously considering closing their market at about noon on October the 20th. And then the most comforting call that he got again came from John just a few minutes later, who told him that was not going to happen. What I'd like to tell you about the most comforting telephone call that I got during this period of time. It really came the evening before, and it came from the then chairman of Nomura Securities, who was in the United States at my invitation. I had invited him months before, when I was still at Alex. Brown, to come to the United States to play golf with me at Augusta. During the week of October the 19th, specifically on the 21st, 22nd, 23rd. And on the evening of October the 19th, after things had settled down a little bit, I got a call from the chairman. And he suggested to me that, that notwithstanding the chaotic conditions of the U.S. markets, that he was very comfortable that the Japanese markets were going to do well, not only tomorrow, but for the rest of the week. That he was very comfortable that the U.S. markets would follow, and that the most important things that he and I could be doing were be playing golf at Augusta. Well, he did, and I didn't. And I can assure you that given the short period of time that I'd been in that job, that, as Bob suggested, that he had a much better time that week than I did. Things have changed, however, both for the Japanese markets and the former chairman of Nomura Securities. Since we're talking about risk factors to orderly markets in the future, I thought maybe I might begin by doing something a little different, and that is talking about what the salient characteristics of those markets might be. And I will take that opportunity also to make comment upon an observation that Bill made just a minute ago. First, I think they're likely to be highly automated markets, and as such very dependent on an infrastructure of computers and communications networks, both public and private, and of course public power systems. Secondly, they will be intensely competitive and international, although continuous global trading of equity securities is some time off. I think markets within the same time zone are increasingly competing for order flow, and markets in other time zones are picking up larger shares of the after-hours market in U.S. securities. I think that Bill was referring to his concern about the growth in both domestic competition and also international competition. Frankly, we don't share that concern. I think it's been demonstrated here in the United States that dealer markets need not be opaque. They are here in the United States are very transparent. Indeed, they're just as transparent as the auction markets. We have the same reporting requirements in the NASDAQ market as they have in the exchange markets here in the United States. And they're, in fact, just as well regulated, as has been recognized by the SEC itself in a release on a memorandum of, in a release commenting upon a memorandum of understanding that NASDAQ reached with the state securities administrators back in 1989. Where they said that, indeed, the NASDAQ market was just as well regulated and just as transparent as the auction markets here in the United States. So they will be, I believe, increasingly dealer-oriented. They will be increasingly competitive and increasingly international. Third, I think this is one we could all agree upon. The primary participants in this environment will continue to be the institutions. Yet I would hasten to add that in recent months, and indeed over the last 2 years, we're seeing in the U.S. at least, and particularly in our NASDAQ market, a growing individual investor participation, both directly and through the funds. Fourth, whether we like it or not, I think the markets of the future will be increasingly commoditized in the sense that trading the market strategies and other short-term approaches that have been commented upon will be just as prevalent as a traditional buy and hold approach to securities. Fifthly, the products themselves will be much more highly customized and much more complex, with financial intermediaries assuming larger off-balance sheet exposures. And finally, the markets of the future will be marked by continuing intraday volatility and episodic volatility. As more people, as Leo pointed out this morning very, very vividly, as more people have access to real-time information and possess the ability and the desire to act on that information instantaneously. What then are the risks that are associated with markets that have these characteristics? What I would suggest there are four, and I will refer to them in ascending order of significance. First, and I think Bill alluded to this, is infrastructure failure. Automated markets are indeed heavily dependent upon computer and power and telecommunications infrastructures, and they're so heavily dependent that a significant failure of any of these systems could pose a threat to the orderliness of our markets. Generally, I would suggest the more prominent the market, the more risk there is for uncertainty and potential crisis if that market should close or its system should fail. Obviously, closing the New York Stock Exchange or closing the NASDAQ market is far more significant and poses a much bigger risk than closing the Arizona Stock Exchange or Instinet. At the same time, I would suggest that it can be said with respect to automated markets that provided that those markets take the necessary steps to build excess capacity and to build redundancy, technology can actually reduce the possibility of market closings. The second risk is unrealistic expectations of liquidity. If we accept the fact that there will be considerable intraday price swings as well as extraordinary market rises and declines, then the real risk is not the volatility itself. Rather, it's that institutional participants, in particular, tend to have a perception of both immediate and unlimited liquidity that simply does not exist in our markets today. On an episodic and stock-by-stock basis, we continue to see that when there are signs of trouble, institutional traders, those gnats that Leo referred to, all tend to run for the same door at the same time. When someone yells fire, institutions simply have to realize that there are only a given number of exits. Individuals and some professionals, on the other hand, seem to have learned from the events of 1987 and 1989 that a market slide is not the end of the world, and thus do not panic and sell. There's even some soft evidence that they are using these slides as buying opportunities, and in the process, backstopping the downturn of the market. A third risk is one you've heard a lot about today, and that, of course, is systemic risk. Virtually everybody we've heard from and virtually every observer of the growth and the use of off-balance sheet customized products has remarked on the potential, on the increased potential exposure that such instruments create for the intermediaries that use them. This continues to be a significant area of concern, which we must address by increasing the sophistication of both our capital adequacy standards as well as our monitoring capabilities. The SEC's recently promulgated risk assessment rules should be a great help in this regard. But there are two other actions that could contribute to a reduction of systemic risk, and both of which Bob referred to in his opening comments this morning. First is for the Fed to take full advantage of its newly created authority over margin levels. While this, I would suggest, would not and should not result in a uniform margin requirement across markets, it does, for the first time, permit one authority to look across all stocks and options and futures markets and assessing whether there is too much leverage in the system as a whole rather than in one individual market. And secondly, implementing the G30 recommendations, particularly those to shorten the settlement period and to move to same-day funds for settlement purposes for professional participants, is highly desirable. Now, this brings me to my fourth and most significant risk, and that is simply the loss of investor confidence. That threat comes from a number of fronts, and a number of those have been commented upon by other participants. But it also comes from the mounting global enforcement challenges, not just the regulatory gaps, but the global enforcement challenges that, if not met, could stand to undermine investor confidence. The fact is that there are bad apples out there intent upon defrauding investors, and they're not at all reluctant to fold their tent and to move from one country to the other to take advantage of what they may perceive as regulatory gaps. To address this risk, we should build upon the existing information sharing and cooperation networks that the SEC under David and Richard's leadership have been creating during the past 5 years to be sure that such regulatory gaps are closed and that the potential miscreants understand that they are closed. Second, I would also suggest that investor confidence is threatened by the proliferation of the new and more complex securities products that we referred to, which pose a risk that the salespeople who will be selling those products do not understand the nature of those products, nor the high, in some cases, the high degree of risk inherent in those products, and that they will not be able to explain that to the customers to whom they are selling that product. Regulators and self-regulators face the continuing challenge of understanding those new products and of ensuring that the people selling them, as well as the people buying them, understand them as well. Finally, I would suggest that we should admit that nobody really knows all the risks that are associated with today's new products, and that this information gap could be the market's undoing at some future time. Now, all of these factors, to me, suggest the potential loss of investor confidence in our markets. And when confidence in the markets is lost, the stage is clearly set for disorderly markets. Let me close with one observation, and I think that is, as an industry, we have done an excellent job in addressing those risks that we identified after the market crash of 1987. The final risk, however, I would suggest to you, is that that very success in improving our risk identification capabilities and our management skills may lull us into believing that our markets are crash-free. The market processes have become so complex that the only safe assumption is that a new source of significant risk will arise that we cannot anticipate today. In the markets of the future, the ultimate risk control technique may be to expect the unexpected. Bob, thanks for letting me share those comments with you.
And our last panelist is the Honorable David Mullins, Vice Chairman of the Federal Reserve Board, who was, of course, a professor at the business school with me, went at the same time I did to the Treasury, and left soon thereafter to go to the Fed, first as a governor and since last July, a year ago this July 1991, as Vice Chairman. David?
Thank you, Bob. I'm sorry I missed the morning. I've learned a lot this afternoon. I was impressed when Chairman Breeden described the issuance in the capital markets this year is almost $900 billion. As the person who used to issue the Treasury debt, I must say that's only a few good months by my personal standards. But I'm on the buy side now, so let me move on. I guess a number of people have mentioned, both Bills and Joe, the importance of infrastructure, and indeed that many of the shocks we've had recently have had to do with physical breakdowns in New York City, and I'd never thought about the new administration's infrastructure program as a market stability program, but that might be useful. I must admit, I couldn't quite figure out Bill Brodsky's regulatory scheme. I guess the way I interpreted it is that he would like the Fed to take over the whole thing, banks, securities, and the rest. Certainly in terms of fragmentation, the banking industry is a good example. I think Bill Donaldson's point about competition and laxity and regulatory laxity internationally is an important point, and we think that market efficiency and competitiveness have to be a guide to regulation, although we also think that well-regulated markets can be a competitive advantage. And we all recall in '87 our markets held up pretty well. Hong Kong closed down for a week or so. Let me do my assignment here briefly. What poses the greatest risk? First, I think we've made considerable progress, and markets are a safer place than they were 5 years ago. When I survey the terrain, I'll touch on two things. These have been touched on heavily, so I won't spend much time on them. First, when one looks at the clearance and settlement mechanisms for heavily traded, high volatility instruments, most instruments, when we look around the markets, are immobilized or dematerialized to facilitate the risk reduction inherent in delivery versus payment systems. In other words, we have stocks and corporate bonds and munis and now commercial paper in depositories, DTC, and soon CDs, I guess, will be in DTC. Some of the mortgage-backed securities that Chairman Breeden had trouble with in Drexel are now in PTC. And, of course, other agencies and treasuries are cleared through the Fed. So we're moving toward a system in which virtually all actively traded U.S. securities and money market instruments will be settled through a delivery versus payment system. So you don't have to worry who goes first. You deliver your securities against payment. Not so in the foreign exchange markets. Even in markets where, for those currency pairs in which operating times overlap, we do not really have good settlement systems. This is the one area of massive volumes of transactions and high volatility without such mechanisms, and as a consequence, and I think we also saw this in the Drexel case as well as the BCCI case, FX settlements remain, in my view, the weak link in what is an increasingly integrated set of domestic and international financial markets. And this raises the old central bank concern of Herstatt risk, named after the German bank that failed in 1974. The problem is, as you know, if someone is paying out yen against dollars, you pay out the yen Tokyo time, and 12 hours later you receive the dollars. If the counterparty fails in the interim, one is paid out the yen but doesn't receive the dollars. And this problem has the potential to create classic systemic risk when the failure of one institution can impose large losses on other institutions, causing them to come under pressure. And it's not only failure. With opaque institutions, when there may be questions about solvency, liquidity could conceivably dry up fairly quickly. If market participants start requiring a troubled institution to pay dollars ahead of time, before the counterparty pays yen, this would substantially increase liquidity pressures. If you think of the first day this happens, that troubled participant has to pay out the dollars it owes from yesterday's yen transaction as well as the dollars it owes on today's yen transaction. The liquidity doubles, and one wonders if there's enough liquidity in the world to support this process if many started behaving in this manner, with FX volumes approaching as much as $1 trillion a day and sizable volatility that we've seen in FS markets. And no delivery versus payment mechanism. This global payments system risk represents a potential threat to the stability of global financial systems. What to do about it? Well, it would be useful to have a clearinghouse arrangement, one with multilateral netting to net down the amounts which are ultimately settled, and it'd be useful to have a delivery versus payment mechanism to settle the netted amounts. These mechanisms should meet the accepted prudential standards. Our view of those standards, or our recommendation is, we've supported the Lamfalussy standards, which came out of our G10 governors process in Basel. And this is a global problem. Complicating matters is the concern about the quality and coordination of central bank services. We don't have overlapping times that our payment systems are open. And the fact that gross real-time funds transfer systems are not universally available, or else they're dominated economically by systems that are not real-time. So this is something we need to work on. It's been almost 20 years since Herstatt failed and we first learned about this risk. And with the growth in the volume of transaction, the potential risk has grown. There are many possible arrangements we might work on toward reducing this risk. One concern that I have is I'm not aware of strong private incentives to set up the appropriate mechanisms, the clearinghouses and the like. Even though there have been some preliminary steps in that direction, there is no obvious regulatory locus, no hook to encourage private development, other than the general prudential concern of regulators. The Basel Accord, for example, there's no capital charge for settlement risk, only replacement risk. I think it would be difficult to design a capital charge for settlement risk. I'm not suggesting that. So market participants need to do more with the encouragement of central bankers and supervisors to limit the risk in the settlement of the FX markets, including exploring the feasibility of introducing DVP mechanisms. And perhaps the G10 study that Secretary Brady mentioned which he initiated, the G10 study of the September FX episode, might provide us impetus in this area, and that's one of the things we are working on. I'll just put in my couple of cents worth in notional values on the OTC derivative issue, because it is so popular. The banking system reports these instruments, the notional values and the credit equivalent exposures. This is publicly available data. As has been mentioned, the notional principal outstanding approaches $1 zillion, I think is the simple way to put it. Actually, third quarter data for interest rate swaps and FX contracts is about $7 trillion. And about half of that, $3 trillion, is interest rate swaps, and about half is FX. Now, of course, that notional value, that's double the assets in the banking system, you might notice. This notional value is meaningless. It vastly overstates the real exposure in these instruments, which is the replacement cost, the credit equivalent exposure. People aren't trading in interest rate swaps principal, they're trading only interest, and indeed what you could lose if a counterparty went under. That credit equivalent exposure averages about 2 or 3% of notional values. And indeed, with bilateral netting under the ISDA master contracts, these exposures can be reduced very substantially beyond that. Without the bilateral netting, in the third quarter of '92, if you sum up the exposure in all the U.S. banking industry, all insured banks, the credit equivalent exposure, what they could lose if all these counterparties went under, it comes to $170 billion. About 2/3 of the exposure is FX and 1/3 interest rates. To put this in perspective, this exposure is not that large relative to a $3.5 trillion banking system. So the good news is the exposure to derivatives in the banking system, at least, is only $170 billion, last time we checked, 5% of the banking system's assets, and that's the good news. The bad news is it's all in 7 banks. So it is a bit concentrated. And in fact, 90+% of it is in 7 institutions. Plus, the 7 institutions are something of a mixed bag. Some of those institutions may not appear on your personal list of the safest and soundest institutions in the country. And for these 7 institutions, the exposure is, on the average, double their total capital. So even though there's not much in the system as a whole, there's quite a bit concentrated in a few large banks, and this is why the area is worthy of close attention. I would view the major risk here as old-fashioned credit exposure, and Bill Donaldson described it well. A company goes under and you have it's like a loan to it, although if the packaging is different, we need to understand the packaging. And with this sort of credit exposure, leads to the traditional concerns of systemic risk, with the problems in one institution affecting other institutions, the financial system, and the real economy. What's needed are sound risk control mechanisms in these institutions. If sophisticated investment banks can lose hundreds of millions of dollars trading strip mortgages in a few weeks, then one wonders how well banking executives understand these things. It's important for these control mechanisms to be put into place, and also for regulators to understand and impose risk controls. Regulators also need to perfect ways to wind down institutions, failed institutions or troubled institutions, how to deal with the positions, the derivative positions. But most basically, the risk here at its most elemental level is old-fashioned credit exposure, the type banks are used to dealing with. I didn't say they were good at dealing with it, but it is the traditional sort of credit exposure once they learn how the packaging works. And indeed, I think this should make us comfortable, because basically what it is, and I think Chairman Breeden mentioned it, is old-fashioned regulatory blocking and tackling. By the institutions and by the regulators. So that should make us feel comfortable. But we have missed a few blocks and muffed a few tackles in the recent history of banking regulation, and that again would just suggest it is worthy of attention. So the other thing I would note is, so far we've had little trouble in this area, despite all the concern. Little trouble from credit risk or market risk, trading risk, or operational risk. The major losses have been produced by legal risk. The ruling in the UK that the municipalities could abrogate their swap contracts. And this underscores the importance of setting up a robust legal foundation in this area. For example, moving ahead with an appropriate exemption under the CFTC Reauthorization Act. So overall, I think we made a lot of progress. We still think, as central bankers, when you look around, the outstanding issue remains the Hairstad risk. That's the open one. And when we have trouble with institutions, as long as there are DVP mechanisms and depositories, you have a lot less trouble with clearing these instruments. And when you don't have them, you have a lot more trouble. And the one area we've had major concern about now for 20 years, we've been concerned, is the FX area. And then I think it's important to understand the nature of the other area, the OTC derivatives, what the concerns are and what the concerns aren't. Thank you.
We've got a couple of minutes, but not too much. So if any of you have some questions for the panelists, I'm sure they would be delighted to answer them. I'm a very reticent crowd. No? I should go to the microphone.
Question for the panel. We seem to have a market today where we have the little guy investor and the big guy liquidity player. And I'm curious, with a new administration here where some people are advocating a reduction in the capital gains rate to stimulate capital formation, particularly people from the high-tech industry, do we think a reduced capital gains rate at this point would increase volatility or reduce volatility in the markets? Question.
I think it would might do a little bit of both. It might increase liquidity, and it also might add a little bit to volatility. I think it would have overall net a favorable effect on a marketplace.
My reaction is that it probably would have little or no impact on volatility, that it would have a positive impact, I think, on the equity capital raising process, particularly for the sectors that the Clinton administration seems to want to target. So, I would concur with Bill on that.
Mr. Chairman?
If there, can I?
Yeah.
Make I just want to make a comment, because perhaps there was a misinterpretation in terms of something that I said, which is that I think when you talk about competition in the securities markets, I think you have to, there are two kinds of competitions. There's competition between markets, and there's competition between buyer and seller. Now, I feel, obviously, heading up the organization that I do, that the competition between buyer and seller is by far the most important competition. The more you can aggregate buyers and sellers in one spot, competing with each other to discover a price, the most efficient marketplace you have. That's the kind of I think the measure of what kind of competition is good is which one gets the best price for the customer. And if, in fact, and what our problem is in terms of fragmentation and so forth, is that somehow the customer is not getting the best price. And I think we need a system in this country, be it either dealer or auction market, where the customer is assured that their order is exposed to the best price. And that's competition we welcome.
Competition we welcome too.
Well,
It's the, I think that the nature of the distinction is a fine one. I would suggest to you that all markets have a best execution requirement. We have one, the New York Stock Exchange have one. We impose it on our members, and that the customers are entitled to the best execution available in the marketplace. So, I think that we all are looking to do what is in the best interest of the customer. We come at it from a different perspective. Ours is a dealer screen-based market. Bill's is an auction floor-based market. The reality is, if you cut all the way through it, and I think you look at some of the innovations of the New York Stock Exchange, adopting some that we have adopted, is that we're trying to use the best features of both markets for the ultimate benefit of the customers.
Chairman Breeden, do you want to commit the exchange in favor of best execution for customers as well? You remain silent on that. Other questions? Well, fine. That means we're actually going to end, as I promised our panelists we would, at 4 o'clock. I want to thank all of you for coming all the way up here. We greatly appreciate it, and the morning panelists as well, you in the audience for coming. My hope is that we will not have to have another Brady Commission in the near future and have another 5-year reunion. Thank you.
Are you really?